Ladies and gentlemen, my name is Jesse Frgali, and you're listening to Working Capital, the real estate podcast. My returning guest today is Micheal Bull. Micheal is the founder and CEO of Bull Realty. He has 35 years real estate experience in investment sales and commercial real estate. He's host of America's Commercial Real Estate Show and the creator of 21 one-hour agent trading videos online, and we'll put a show link for you to access those. Micheal, how's it going?
Excellent. Thank you, Jesse.
Well, it's been a little while since you were last on. If those who are interested in the first episode, you can look back at workingcapitalpodcast.com. Just type in Micheal Bull, and you'll be able to find the first episode we did. But fast forward to today, it's like we say every time we have a returning guest, a lot has changed over the last year to 2 years. So why don't you just give for those that haven't listened or seen that first episode, just a little bit of a background of kind of what you do and how you've been doing the last couple of years.
Yeah, well, great. Yeah, so I started selling commercial properties while I was in college. I was 19. At 22, became full-time commission sales guy. So been doing it all my life. Started Bull Realty about 25 years ago, regional firm. We have brokers in every specialty. Started hosting America's Commercial Real Estate Show about 12 years ago, do a show every week. And then when created commercialagentsuccess.com, the 21 one-hour training videos, the agents love those around the country. And then I lead a team personally that sells office buildings. We sell government leased office buildings, medical office buildings, and regular office buildings. And that's been quite interesting lately, as you know.
So I guess we can just dive right into that, picking the asset classes to chat about first. Office in general, for the listeners that are agents or investors or real estate professionals in general. I mean, it's no surprise that certain asset classes over the last little while have been kind of the hot to trot type of asset classes, while some have been lagging. Where is office at these days? What are you seeing on your end on the sales side? And I guess as an extension on the leasing side?
Yeah, so the majority of office buildings are lagging, right? The sales velocity is down. A lot of the occupancy is down. That's not to say all of them. Our government leased office, our medical office, some of our really nicer Class A buildings are doing well. Some of the smaller suites in some markets and cities are doing well. So it's not overall the entire country, right? But certainly there's a lot of turmoil in the office market, especially in the CBDs and the big cities and some of the older vintage buildings. So we're seeing some of those get turned into other uses, some of them being foreclosed on. And I think there's going to be a lot of money made in the office sector over the next 2 or 3 years because there's going to be some really low price point purchases. And I think the office market is going to continue to experience some lack of demand for the next year or two. But as more and more companies each quarter see the results of the work from home and the employment market changes, when employers can actually tell employees, hey, get to the office or find another job, then I think the office demand will start coming back. So folks that get in and buy office now may have some great opportunities for huge upside. I think the challenges with work from home are many. While there's a lot of us and a lot of companies can do well with it and did even before the pandemic, there's some that most of them are really suffering with onboarding, with cybersecurity, with trade secrets, with culture, just top line, bottom line numbers. Turnover costs companies a lot of money. And there's no sense of belonging when people are at home. And so I think more and more each quarter, more companies will experience the issues for both their employees and for the companies. And so I think demand will slowly start coming back. So I think office might be the sector that has the most challenge. It is definitely the sector that has the most challenges right now, but also might be the sector with the most upside for those distressed buyers that seem to always be looking for deals in down markets.
So the question I always get, or you see it online, that these office buildings, they're just going to get converted into residential, or they're just going to get converted into another asset class. Where anybody in construction or that works even in commercial real estate, it's not as easy as just slapping a sign on and saying residential. Are you seeing a genuine a genuine push to conversion of certain buildings, and what type of buildings? Because there, windows, elevators, if look, anybody online, if you're curious, just see how those conversions work. That probably a quick Google search can show you some of the challenges that they are not built the same for the most part. But I guess the question is, are you seeing a genuine shift to looking at them for conversion? And are there certain types of office buildings that are better candidates than others for that type of strategy?
Yeah, there are, and of course you need a price per foot that makes sense, right? To get that shell, and you need the smaller floor plates are better. The buildings that have good windows are better. Obviously, a good location with parking are better. Some buildings with style are better that have a draw to them, right? We're tracking all the distressed buildings across the country over 50,000 square feet on my team, and we're tracking the ones that we think are good for conversions by looking at the buildings that potentially are convertible, starting with the price per square foot. And then we study the apartment market in those markets and see, well, is there enough demand? Are the rents per square foot enough that it's something to look at? So I think there's not a lot of them that are convertible, if you will, but some of them are being converted. So it depends on the locations, right, and all those other parameters.
It seems to me that some of these that are candidates for conversion are not really the ones that you're seeing in the downtown cores, these large commercial buildings. It's potentially these periphery, smaller-ish office buildings that might be the better candidates. It just seems that these downtown massive buildings, it'd be very difficult to make the case to convert them. Is that kind of what you're seeing when you're tracking this?
Yeah, that's one of the factors, and but I think some of the companies converting them like the larger buildings because the small deals just are harder to deal with for them. So I don't know that size matters there. I think it's more of the building and the ceiling heights and the windows, the floor plates, the style, the demand in the area, and the parking. And start with price per square foot. But it's interesting. One of the things that you get out of it is you potentially get a building that has a draw, that already has a story. And secondly, you save a lot of time because you already have your shell and your infrastructure, right? So you can save maybe a year on bringing something to market. So you might save up to a year of interest carry, which can be big, especially with the higher rates.
So on the micro level, we see, we've talked on the podcast before about the office leasing market in different geographical locations, but you see a lot of deal flow on the investment sales side. What's the investor sentiment on specifically office assets? I know that, it is lagging, but like you said, usually where there's potential depression on pricing, there's potential opportunity. So what are you seeing investors looking for or not on the office end?
It's a bit of a changing market as we speak here, at this point in 2023, where, a lot of sellers are realizing their values are down and admitting it, right? And some of them going and turning the keys back in. So, we'll start to see more and more sales comps that will make more of this happen, right? When the comps are there for these distressed sales, then the banks and lenders will have to right size their portfolio and their values, right? So I think we're going to see some more distress, and I think it's a changing market. And when you have an office building with a lot of vacancies, there's a tremendous amount of cost, right, to get that back stable with leasing commissions and tenant improvements and build out and the capex that are needed and the interest carry while they're empty. And so the price per pound for those buildings has to be fairly low for them to be convertible and for folks to buy them. It's an interesting asset class when you talk about a lot of vacancy or distress, because it's so much money to get them back up.
Yeah, we found the office assets in general for a long time. They especially the real estate investment trusts, they didn't want to move their net rents, and still to this day, what we're seeing is, if there's movement on pricing, it's coming in the form more so of incentives and free rent, as opposed to specifically dropping the net rents. Are you finding that kind of incentives have gone up, or even potentially fees, or are you finding now there's kind of a come to Jesus moment and they're actually realizing they're going to have to pull the actual net rents and offer more of a discount?
Yeah, I think both. I think it depends, on the group that owns the property and asset manages it. But yeah, we're seeing both. And I was with a large an asset manager of a large REIT a couple of weeks ago, and we were at a networking event, and he gets a call and interrupts it and comes back and says, "Michael, that's really interesting. That was like a 2,500 square foot lease. And I interrupt my whole life and did whatever I needed to do to make sure that happened." He says, "What a different world." I wouldn't even return a call on a 2,500 square foot lease 3 years ago.
Yeah, our key line right now is bird in hand, and don't lose a deal if you've got a good tenant that if it's a bit of a discount, it's better to have them lock them up for 2, 3, 4, 5 years. On the just kind of shifting towards the other asset classes right now, Bull Realty, you guys kind of run the gamut when it comes to different asset classes from hotels to industrial. What are you finding are the top asset classes right now, and are there kind of any surprises in 2023 and even maybe at the tail end of 22?
I don't know if there's any surprises, but we're finding the industrial markets very hot. The single tenant net lease investment market is very hot. Medical office still very, very hot. Senior housing starting to come back, and there's some operational issues with cost, but those values starting to come back. And then self storage very strong. So and retail surprisingly strong. When you look at the cap rates, some of these retail properties are getting, they're still pretty strong. So because the retail has been performing so well. So really, when you look at the different types of properties, it's really the office is really the main one that tends to be suffering right now. The others really aren't that bad, except for the change in valuations based on interest rates.
Mm-hmm. So on that point, what we found last year, industrial and multi-res remained extremely strong, especially industrial. But on the interest rate, you can only increase so many times before you see that downstream effect with investors. And we found that we went from bid dates in multi-res to no longer offering bid dates, but having a decent amount of traction on good properties. Where do you see things going for, I guess, generally for different asset classes with where interest rates are, but specifically multi-res? Or do you see a bit of same thing, a kind of more realistic spread between bid ask, where people are actually valuing a little bit more realistically?
Not really. Not the market we work in a lot is the Southeast U.S., and then we're headquartered in Atlanta. And so, the markets that we're dealing in have strong demand, a lot of buyer demand, a lot of still upside potential for demand and from tenants and rents. So we're still seeing some remarkably low cap rates. We're going to take out $100 million Class A multifamily in a few weeks, and we look at the comps on that, and it was like they're really capped still at 4.5, 5. Yeah, there are. And it's a beautiful, beautiful property, and I think it'll get a tremendous amount of demand. So obviously it depends on the geographic and the properties themselves, right, and the demand in those submarkets. But a lot of the markets we're dealing in, there's still really strong demand and low cap rates for multifamily and industrial, and in self storage and in single tenant net lease. I still see really low cap rates there.
I guess for those that don't know, the single tenant net lease, where you have basically a your net income is pretty much guaranteed, and then you have your additional rent, and it's really relying on the covenant of the tenant or the strength of the tenant. I'm assuming that's more of those low cap rates are a reflection of people or investors wanting a bit more certainty with their costs and with their tenants.
Yeah, that's what we see in downturns throughout my career. There's a single tenant net lease market fluctuates less on the cap rates because of the safety of it, right? When you got a super high credit tenant that rarely ever defaults, and you got a triple net lease where it's mailbox money for you as a landlord, some money will go into those property types. So there's enough demand that it keeps those cap rates pretty low for the most part.
And what are your clients and investors? What's the sentiment on interest rates? It's been pretty much a hockey stick graph in terms of the Fed's raising rates. What's the chatter on that front?
I think most of the clients we talk to think the Fed's crazy for raising it so fast and waiting so long to do it. And I think it's a huge mistake. And they're looking to dump the economy, and that's what they're doing. And no more soft landing, right? We're having a hard landing, and that's what they wanted to do, and that's what they've done. So I think it's as far as what sentiment on what interest rates are going to do. I guess we're starting to see some sentiment that maybe the Fed's through screwing us all by raising rates too fast. We'll see. Let's hope.
Yeah, I think we're feeling the same thing. I don't know if it's out of desperation, but I think it is at least the 12 month look is maybe another raise and kind of flat for a while. But I think the larger worry is kind of what you're kind of alluding to is, do we go flat for a little while and then we're in a recession, or we're in an economic kind of a headwind situation and dealing with that, because that is still the possibility. We get to this point and then we're in a downturn.
And I don't mind the rates where they are. I mean, I've worked in a lot of much higher rate environments, and clients and brokers, everyone doing well. It's just raising them that fast was, I think, idiotic. And I think you're right. I think it's a possible recession or worse. But because the repercussions of these rate increases take a long time to happen, but they're moving the rates so fast they're not feeling the full effect, and they keep raising. It's awful, I think.
Yeah, it's definitely. I agree. It's in terms of how they're doing as opposed to the actual rates themselves. Because even myself, who I didn't live through the 80s and early 90s in commercial real estate where you had double digit rates, and but even when I started investing earlier in 2007, 2008, 5, 6, 7% was the norm. It wasn't. Nobody kind of thought that was odd. It was 1-2% that we've kind of got accustomed to, that I think is, if that's the anchor, that's not a good situation.
I remember when we could get a 12% interest rate from owner finance, and we were just so excited that was that low, and people still making money. I had a triplex when I was really young with a 17% interest rate loan on it at one point, and I made money with it.
So are you seeing, just on that point, are you also seeing more creative financing as it relates to VTBs or seller financing in this market?
Yeah, it's a good point. We're seeing it come back. It's interesting. I do a good bit of training for brokers and speak at events and stuff. And it's like, I haven't talked about owner financing and wraps and unwraps and note sales and REO and distress short. I haven't talked about that in so long. Some of the brokers that I'm training now, they're like, never heard of this stuff. And it's like I've got to review a contract next after this on a pretty complicated owner finance wrap kind of deal. So yeah, we're seeing more of that. A lot of assumptions, and some owner financing. And for some of these sellers that are retiring or don't want to reinvest that money in another property, owner financing can be a great way to go. Right. They've got a good return from the owner financing. It's secured by an asset they're already comfortable with, especially if it's in a state with non-judicial foreclosure. Then, they get enough down payment and a proper operator. It can be great for sellers.
Yeah, I think for, investors or, vendors, buyers, if you're looking at seller financing, it really can be a benefit to both sides, whether it's a tax perspective from the vendor or, just the ability to carry on debt and have a little bit of income. And then it could be a matter of the purchaser, being able to complete the deal to actually get that debt. But like you said, secured to the property. But it's funny how it's times like this where those creative solutions start kind of popping up again.
Yeah, I did a whole hour training on creative solutions on sales and at the commercialagentsuccess.com, and it's like it didn't get many sales, and now I think we're going to start seeing it pick back up. I think when you're creative, you help clients and you help get deals done. Just so everything's above board on top of the table. If a buyer and seller or landlord or tenant want to do a deal, there should be a way to work it out.
Mm-hmm. So you mentioned kind of the sandbox you play in terms of geography. We've seen a lot of, people voting with their feet, especially in the States, moving to different states in the South. How have you seen the kind of the movement of real estate purchases? Because we have seen a lot of people looking at, states like Florida, kind of moving from northeastern states. Is that still something that you're seeing where people are moving their money to, maybe little bit more favorable on the rental and landlord tenant side, or even just on the valuation side?
Absolutely. Yeah. We're seeing a lot of New York investors want to move out of rent control type environments and high taxes and get into maybe higher growth markets in the Southeast. And so a lot of our buyers in the Southeast are from California. They're from New York. And they're selling assets there and moving to more higher growth markets. Yeah, we're still seeing it.
And is that something that is part of just kind of the current environment that we're in, or is this something that has been the trend for some time?
Yeah, I think it maybe started in earnest during COVID, right? But I think it's going to continue, especially in these markets where they just keep raising taxes and do things like rent control, which really causes more problems from the tenants than no rent control because it hurts supply. But yeah, I think it's something we'll continue to see. When it first started, I'm not sure.
When it comes to individuals getting into real estate, just as a professional, whether it's in brokerage or not in brokerage, I get a lot of questions, which asset class, when's the right time? Um, and we've talked about some of these asset classes that are doing really well and some of the asset classes that aren't doing so well. What do you tell young people that are getting into real estate? Because, when I started, the asset classes that are booming right now were not the ones that were booming. And I find, our industry is extremely cyclical. So picking based on that and where we're currently at maybe isn't the right approach. So love to get your thoughts on that.
Well, I think you just illustrated part of the answer there is, first of all, I ask, well, look, are you looking to invest in real estate or are you looking to be a broker? Right. So first of all, you got to look at it that way. If you're looking at to be a broker, then you're looking at probably a lifelong career specialty. And so it's going to cycle and you don't make money on properties going up or down in value. You make money on transactions. So it doesn't really matter if it's going up or down or whatever. It really is about the number of transactions and how much market share of that can you get. So when brokers are looking at a specialty or a vertical to do, I try to figure out, well, what excites you the most to do the rest of your life or the rest of your career, and what's in your background that would help you add more value to that arena, right? And so that's what I would tell them, and because it's going to fluctuate, like you said. When it comes to investors, then I like to figure out, well, what other assets do they have geographically? How old are they? What's their plans? Are they managing it? What's their knowledge base? What have they owned before? And to get started, I think investing in looking at, do they have a business and do they need office space? I think that's one of the gold mines for companies right now. If companies go in and get and acquire some of these office properties at way below market, and then hold these things for 10 or 20 or whatever years, huge windfall for users. I think this is a wonderful time for companies using space to acquire properties, even if they have no down payment or don't want a down payment. If they're occupying and filling a vacancy, then they could team with an investor. So I think that's one of the things I see office tenant reps kind of miss out on sometimes is, if you're filling a vacancy of a single building or even a multi-tenant building, if you may be creating more value and you may be able to bring an investor in and even get the tenant a piece of that pie. I had an investor who contacted me. Well, actually, an occupier was going to lease an entire freestanding building in Buckhead, Atlanta. He needed about $1 million for equipment. It's for medical. And he said, Michael, can you loan it to me or get me a loan? And I looked at it and said, well, why don't we do it this way? Why don't we put the property under contract to purchase? Well, it's vacant. We'll create a triple net lease at market rents for 10 years, guaranteed by the two doctors. We'll sell that on a single tenant triple net lease. The value increase even after paying my second commission will be $1 million. So I can actually hand you $1 million instead of letting you borrow $1 million. Is that better? This guy's a doctor. If anybody asks about commercial real estate, he's like, call Michael. But I think there's a lot of opportunities for occupiers and a lot of opportunities to get into still get into some great properties right now.
Yeah, that's a great example. It's funny too, because we're dealing with something very similar. Whereas, if it's a multi-res building, typically they want vacant possession, especially if it's if it's a rent control area. Whereas with office, right now it's preferred that there's good income on it. And we have a very similar situation where we have an offer for leasing. And what we've told our client is, listen, if we can tell this investor that's looking to buy that if, you condition the deal on this offer to lease, we can, have, like you said, close to or above a market rate. You have the lease in place and now you've purchased with income. So I think it just goes to the point of thinking outside the box on during times like this, which kind of forces you to. I want to talk a little bit about America's CRE show. I know we talked a little bit about it last time. For listeners that don't know, could you give kind of the high level?
Sure. Yeah, we do a weekly show every week for a little over 12 years. Started on one radio station. It grew to about 60 stations around the country. We started the first one as a podcast as well. And we eventually started dropping the radio stations because they're AM stations and we just weren't getting any feedback from them. And our downloads were increasing on the podcast. And then several years ago, we started doing video as well. We built a TV studio, news station studio at our office called Studio One, and started doing video on them as well. So, and we have, it's a show geared to principals. Like I just taped a show on entitlements and zoning with strategies for developers, landowners, brokers, all of us that help folks like that on rezoning properties. And it's pretty interesting. We just did a show the week before. I think it was on multifamily. Week before that on industrial. Just giving an update, forecast, strategies. We have analysts and economists on from, I don't know if I think I'll have him back, the Fed. I like Brian, but the Fed is making me so mad these days. But from the Fed, from Moody's, from CoStar, from RC Analytics, now Moody's. But, we have a lot of economists and analysts and gear it toward principles. It's been a fun show. A lot of work for the first 3 or 4 years with not many listeners, but now a lot of listeners and a lot less work. We have a professional producer and people that help run the show. So I get to walk in Studio One, do the show, and walk back out. I just plan who we're going to interview and what we do.
That's funny. That's how it always goes. The first year or two, you feel like it might go in the right direction here.
Yeah.
That's great. So it's basically kind of a pulse on the market. You're talking to real estate professionals and getting a sense of what's going on. And I think I remember the first time I saw that there was video, which was, I think, through the actual podcast. So it's weekly. And how long is the weekly show, Mike?
Yeah, since we're not on the radio anymore, we don't have a strict clock. So what I tell my guests when I'm interviewing them, that when they ask me how long the show is going to be, I tell them until they're boring.
And we're going to wrap up. Yeah, I hear you.
Right.
That's
Jesse's
great.
like, all right, Michael, we're wrapping up now.
That's awesome. No, it's good to hear. We'll put a link up for that. And just want to be mindful of the time here, but you mentioned also kind of the training that you're doing with people on the brokerage end. If you could just give a plug for that, and we can put a show note up for that as well.
Sure. And to directly answer your question, the shows will be anywhere from 18 minutes to maybe 40 minutes tops, depending. I just want to make sure they're providing a lot of great information and we're not repeating anything. So commercialagentsuccess.com. It's 21 roughly 1 hour videos for commercial agent training. So I've had all the commercial agent training in the world. I always have. I've had all the big trainers in my office. I've had them all on my show. I'm really into training. And so I realized there was a lot of things missing, and I started creating it over the years and perfecting it all the time. And then I thought, well, one day somebody will probably buy Bull Realty, put me out of my misery, and then I'll just speak and train and coach potentially, because I do speak at events around the country. But then I realized that I was getting kind of old. I didn't really want to sell my business. If I was going to sell training, I better do it now, so I'm not on the stage with a cane and a walker going, "This is how you're supposed to do it, Sonny." So I went ahead and created commercialagentsuccess.com, and people love it. It's inexpensive, and they license a video online to get it immediately. It's always there for them. It has action notes. There's a calculator. There's forms, and there's to give an example. There's one called "Say This, Not That." And it's just spectacular about the language we use and how we can increase our results and improve our percentages on results by just changing our vocabulary.
Mm. Yeah. First one that comes to mind for me with clients is issues and challenges. We got an
Right.
issue or we got a challenge.
Right.
Before we let you go, Mike, I want to ask. I know we've done the final four questions last time you were on, but I just want to, for listeners' benefit, are there any books or podcasts aside from your own that you'd recommend for people in the industry, getting into the industry? Anything on the bookshelf?
If they're investment sales brokers, I'd recommend Brad Umansky's book, Value Added. If you're doing investment sales, I think he did a great job with that. I like soft selling in a hard world for sales and negotiation. So I think, we want to have exceptional sales skills as brokers, but we're only trying to help people make good decisions. So I think it's you want to do it the right way. And when I first got in the business, I saw commercial agent sales agent as the title, and I'd never met a salesperson that I was impressed with. And I didn't want to become what I thought were jerks. The only ones I'd met when I was young, salespeople. So I studied a lot, and I think that's the reason I made it. I think when I see my brokers that do extremely well here at our shop, they had a sales background before they got here. None of them had a commercial real estate background, but they all had a sales background, and they get it when they get the training from commercialagentsuccess.com and stuff. As salespeople, they go, "Oh, that's great, that's gold." They get it, right? So I think anything on, I tell, if you're a broker, go get the top 10 sales books throughout history, and listen or watch them or read them over and over again. Not on real estate, not on the last year, but throughout history, because sales is sales.
My guest today has been Micheal Bull. Micheal, thank you for being part of Working Capital.
Jesse, thank you.